An economic storm is about to begin. Hey, everybody, you're watching Bull Boom, Bear Bust. We have nations out there warning the U.S. about tariffs and even threatening retaliation. We're going to talk about that here in this report and a lot more. The GDP numbers are out. The inflation numbers are out. A lot of new data and information to get into. Please make sure you're subscribed. Let's go ahead and get right into it. And let's start right here. Out of BBC, no one will win. Canada, Mexico, and China respond to Trump tariff threats. And here's how Mexico put it, quote, "To one tariff will follow another in response, and so on, until we put our common businesses at risk," unquote. That was the statement out of the Mexico president. Now, what I'm afraid of is we've lost so many jobs in the U.S. over the past many, many decades. Does the president understand that we really do not manufacture much here in the U.S.? I'm talking about the incoming president. So to me, this could be very, very problematic with all the other inflationary forces that we're already seeing. We already know there's going to be a push to lower interest rates and a push to allow banks to continue to loan out money to the consumers that are already in big, big trouble. We talked our last report about how car sales had plunged, but prices, even though they're down from the peak, they went up again last month. Right? We're seeing it in the housing market. We're seeing prices staying very, very elevated. But when you look at the state of the U.S. consumer and the plunging savings rate that most people have, very little money in the bank, record amounts of debt, people just don't have the money to go out and buy these things. So, of course, more people are financing things, and they're financing larger amounts, and that's being enabled by the banks. So we're seeing this happen, and we don't want to see anything else on the side of inflationary forces. We want to see more deflationary forces. Unfortunately, when deflation occurs, it's usually in conjunction with a lot of job losses. And here's just a roundup of some of the headlines that are reporting on this tariff warning from Mexico and Canada. We'll talk about Canada here in a bit. Mexico president sends warning over the tariff proposal. Proposal will cost the U.S. 400,000 jobs. Also, China warning against tariff trade war as the threat is out there to hike tariffs. Also, recently, price increases accelerated, aka inflation. CPI accelerates last month, and the AP is putting it like this: U.S. consumer prices increase accelerated last month, with inflation pressures resilient. According to the Fed Preferred Inflation Gauge, consumer prices rose 2.3% in October from a year earlier. The Commerce Department said it's up 2.1%, up from 2.1% in September, though it's still only modestly above the Fed's 2% target. Well, we talked about this before. The whole 2% target is nonsense. It used to be that they wanted an average of 2%. Now that's just the target, and if they don't hit it, it's still okay. So it's really pointless to even have the 2% inflation goal or target based on what they're doing, right? Remember, it used to be average inflation, meaning we would need several years of deflation right now to make up for the previous years of well above 2% inflation. They took the word average out of there, and now it's just the 2% inflation target. But then they came out and said it's okay if we don't hit the target, right? As long as we're on the way there. So now we're not even on the way there anymore. We re-accelerated in October, meaning price increases accelerated. So it's insane, folks, but that's what's happening. And it's interesting how the bankers are celebrating that inflation's coming down, but it's only down compared to the record-breaking inflation that we saw in 2021, 22, 23, where it was up to 7 and even as high as 9% year over year at some point. So what's happening right now, it's absolutely bonkers, folks. But this is the situation that we're in, and it could likely get worse with the tariffs. Now, what do you think about this? Are these other countries out there warning the U.S. about the tariffs? Are they just full of nonsense? Is it a nothing burger? Or do you see it as a threat? And if you don't see it as a threat, where are we going to get these items at, right? We import the majority of the items that you see on the store shelves here, folks. So if we start tariffing these other countries and making those prices rise, how is that going to help with the average person. How's that going to help with inflation? And I'll back it up with this. Ultimately, yes, it could bring back jobs. But if the cost of living doesn't come down, and if the cost of living doesn't come down and wages that these companies have to pay, if they do bring their companies back to the U.S., how are the companies going to pay these wages that will allow people to make a living in this high cost environment? If the cost of living doesn't come down and the tariffs could actually make the cost of living go higher, how are companies going to come back here and start up a bunch of manufacturing facilities, right? Maybe I'm missing it. Maybe I'm wrong. I don't see this, folks. I see worsening inflation coming up here, but please let me know what you think about this down in comments. Now, one news outlet gives us a list of the items that are most likely to see spikes in costs. Gas, we'll have to see how that goes with the drilling. Produce, so many of the avocados and more that we get down from Mexico. Cars, a lot of cars imported. Alcohol, the bottom line they say is going to hurt. Again, we'll see how it plays out. I've always warned everybody here that it's going to take a lot to stop the cost of living from going up because you have this fuel on the inflationary fire, just like we talked about in our last report. There's an unlimited amount of fuel they can throw on this fire. Instead of trying to put the fire out, they're putting more fuel on the fire, basically to kick the can down the road. And all the numbers that they put out there to try to convince people that the economy is good, all those numbers start going negative. And that's when they can no longer hide it and they have to officially declare a recession. But remember, a way to avoid a recession is just to keep people spending. In other words, keep banks lending. In all the countries here that we talked about many times that went into hyperinflation, on the way to hyperinflation, they never saw a recession because people were spending more and more and more because the money was still being pumped into the system and propping everything up. So even though they never saw a recession, they ended up in a very bad situation with hyperinflation and literally wheelbarrows full of money in some cases. Remember those pictures out of Zimbabwe where people had wheelbarrows full of money just to go buy some food at the local market. But of course, in the U.S., it won't be wheelbarrows full of money. It'll just be credit lines and credit limits on those plastic cards known as credit cards that never get dropped. They continue to increase because they're just going to keep on pumping liquidity into the credit card companies and into the banks. U.S. economy grew at 2.8% in the third quarter on consumer spending. There you have it right there, folks. They even admit it. This is out of the AP. Consumer spending. And I apologize about the noise. I've got some tree trimmers, not just tree trimmers, but tree removal people taking trees away from my property because the insurance company basically threatened to cancel my insurance if I didn't take away these trees. We'll talk about that in a future report. I'll actually show you outside of the house where the trees had to be removed. But yes, 2.8% pace. And what does it say here? On consumer spending. So more debt being taken on by the consumer enabled the U.S. economy to quote unquote grow, in this case at 2.8%. So 2.8% again on the back of spending, which is debt-fueled spending. Without the capability to go further into debt, the economy would have crashed a very long time ago. So because of that deepening plunge into indebtedness amongst the population, amongst most consumers, we have headlines like this. Credit card delinquencies mount, the Fed says. Consumers' credit card delinquencies have risen this year along with their balances. Well, of course, it has to continue to increase. The debt has to continue to increase to keep the economy from imploding. Credit card delinquencies, as measured by third quarter of this year, rose to their highest level since 2010, surpassing 4%, even as overall consumer debt for card, auto, and student loan was about the same as last year. That's not true. The rate of increase was about the same as last year, but the overall numbers, the total balances are much, much higher. So I'm not sure what they're trying to say here. This is out of Payments Dive. The third quarter increase in credit card delinquencies was mainly due to non-prime borrowers. So people with really bad credit scores are still able to go out and borrow money. Even as balances rose slightly for prime and non-prime card holders, they're admitting there that balances rose. Quote, auto and credit card loan delinquencies remained above pre-pandemic levels, in part reflecting extension of credit. There we go. The bank's extension of credit to riskier borrowers, the report said. So they're actually admitting it. in the text of this article here. Now let's jump on over to housing, and in this case, rentals and evictions. Evictions are increasing, folks. We're seeing more stories, and here's just one of dozens of stories I just read in the past few days of evictions here. Facing eviction, Auckland man allegedly starts his own mobile home on fire. So now, in addition to not having a place to live, he's going to go to jail. Or could that have been his strategy to have a place to live, to have a roof over his head, aka jail? Release from Eau Claire PD says a call came in at 10 a.m. The homeowner, 51-year-old Patrick Bichelle, had recently been evicted from the mobile home park. They questioned him if he started the fire. I mean, what are the odds of the fire starting right after he got evicted? So to me, it looks like a desperate way for someone to maybe even go to jail on purpose instead of being homeless. I'm not sure which one would be worse, being homeless or being in jail. Maybe you can let me know. What would you prefer if you had to be homeless, but you had a choice between that and jail? What would you choose? Jail, where you get probably 3 meals a day, but you might get some, don't drop the soap, you might get beat up and stuff like that. Or homelessness, where you're going to be out in the elements, bad things might happen, you're going to be freezing. Or maybe it's freezing in jail too, who knows, depending on the jail, right? Here's another one. Evictions could spike across Oklahoma. So we have the expiration of protection programs that have been going on now for many years, and many states were afraid to discontinue these programs. The Landlord-Tenant Act hasn't been updated for decades and is quite favorable to landlords. So basically what they're pointing at is the levels of debt and the number of people that are getting behind on their rent. And it's not just Oklahoma. This is just a recent article that I happened to come across. But this could be worsening across the United States as we continue to go forward. And if renters weren't in big trouble enough already, look at this. The incoming administration eyes rollback of the current student loan debt relief program. So now all these people, a lot of these students that thought they were going to get their debt discharged and erased, may be in for a very rude awakening. And how is the economy going to continue to grow now that millions and millions of students that thought they were going to get their loans discharged or erased, they're no longer going to get those loans erased? So now the money that they were spending, thinking they were not going to have to repay their student loans, they're going to have to pull back on a lot of the spending. And how's that going to impact the economy, right? So a lot of balls in the air, a lot of stuff to think about here with the incoming administration. That's why I continue to say I'm being very, very cautious here, because we could see a lot of things pop off, because there's a lot of people that don't want a lot of these policies to be put into place. And we've just covered a few of them, the economic ones, but there's some other ones outside of just financial economic that many people are very fearful and warning against, that it could cause some major chaos and upheaval. Here's another one. Vantage Score reports growing financial pressures. Reports show surging delinquencies and credit balances, including high-income earners. So even people with high incomes are feeling the pinch. Let's see here. The 2024 Credit Gauge Report. National Credit Scoring Company discovered that white-collar workers or high-income consumers who earn $150,000 or more are facing unprecedented credit stress. Delinquencies on 60 to 89 days past due category increased more than twofold, folks, more than double, from January 23 to October 2024. That's far outpacing middle and low income groups. So wow, it's pretty interesting that the 150,000 plus income earners are actually seeing the biggest spike in delinquencies, and it's affecting their scores here. Some of the key findings from October 2024 include the following. Credit account originations. Overall, new credit account originations were down across all products. Credit card accounts decreased by a whopping 0.25% over September. Credit card balances and spending. Here we go. Here's the meat of the matter right here. Overall credit card balances surged to a new record level. So even though new accounts dropped, the balances surged. So there you go. That's why the economy still looks like it's growing. Overall balances surged to a new record according to Credit Gauge, increasing $384 billion month over month. Oh, I'm sorry, this is the average. Increasing, which is just per person, $384 from month to month. That's average. To now $105,600. So the average credit balance now is $105,600. Folks, that is a lot of debt. All right, let's shift gears a little bit back over into housing. In this case, a topic that we used to cover here quite a lot, homeowners associations, folks. Look at this story here. This is out of MoneyWise. Miami condo owners slapped with $21 million special assessment for fees and repairs to the building that's only 16 years old. So 21 million collectively across all these unit owners, homeowners, individual bills exceeding $40,000, folks. This is the threat. This is the thing that a lot of people went to. They went to homes, and in this case, townhomes or condos that had homeowner associations, but you don't really own the home. You're listed as the owner. You may have the deed, but you're going to have to pay whatever they say you have to pay. The homeowner association basically owns you, and you can go to court, you can battle against them, you can fight against them. You may or may not win, but it's very distressing to a lot of these homeowners. Imagine having a $40,000 assessment because of upgrades or things in the common area like the roof or the exterior of the buildings. I think it's excessive. Oh, of course. You think so? Resident Nima Majur told CBS News, "I feel like I'm being milked." A special assessment fee is paid by the condo owners on top of their usually monthly maintenance fees. So on top of the regular HOA fee, which could sometimes be $500, $1,000 or more per month, you're getting this special assessment. According to the report, the condo board approved the special assessment fee based on findings from a structural integrity reserve study, which noted most systems were generally serviceable, but some require immediate repairs. So the money these people thought they were saving by buying a attached unit or a townhome instead of a single family detached resident, turns out they might be paying even more than they'd be paying if they would have bought a single family detached home without an HOA. But if you noticed, it's becoming more and more difficult to find a home that's not in a homeowners association. So it's almost like somebody wants you under the thumb or under control of a higher entity. That's what it seems like. However, building residents claim the process was rushed, needed more transparency, and bypassed the formal unit owner vote. So they didn't even get to vote on it. So that's another thing. You have a lot of shady practices at a lot of these homeowners associations. They're questioning both the necessity and speed of the decision. So how many people have time to sit there on top of your everyday routine, having to work, take care of family, whatever it is, take care of yourself, do your laundry, etc.? How many people on top of all those just regular everyday things that most of us have to do you have time to go to battle against your own HOA board, go to court, whatever it may be, file paperwork, file complaints? It's just a very sad situation. And I think a lot of people are going to be really hurt, with this rising cost environment. And of course, the rising cost of living, inflation. HOAs are using that as an excuse. They're saying, well, the cost of living is going up. We have to raise our prices. I hear that out of insurance companies, out of retailers. We have to pay higher wages. So now we're raising our prices that you have to pay. So pretty much everybody pays for this, folks. So not a good situation. But inflation, again, is the only way to keep the economy looking like it's growing, right? So more debt, folks, more fuel to the fire. Where does it stop? Or is something big going to come in and put a monkey wrench into this system here of money creation, right? So I'm bracing for that, folks. I see a lot of threats out there. We have what's happening over there in Europe, coming to our shore here in the U.S. I think we're going to see a lot of upheaval and chaos in the U.S., not just because of the war, but because a lot of these new policies that are scheduled to be implemented here just in the next couple months. So definitely not out of the woods by a long shot here. Brace for impact. Prepare. Let me know what you think about all this down in comments. Am I correct on the tariffs, or is that going to fix everything? We're going to see massive amounts of jobs come back to the U.S., therefore prices will go down. Well, if the companies are going to come back here, let's say they do, but they have to pay higher wages because the cost of living here is so much higher than other countries, how are prices going to go down? Right? So I don't think the jobs are even going to come back in the first place, but maybe I'm wrong. Again, like to hear from you down in comments. Thanks everybody for being here. Make sure you come back for another report. Hit that notification bell. Share these videos, like, subscribe, all that good stuff if you like what we talk about. Thanks everybody for being here. Happy holidays. I may not be here tomorrow. Tomorrow is Thanksgiving. So hope you have a wonderful day. Hopefully a relaxing day. But either way, happy holidays to everybody. Happy Thanksgiving, whatever you prefer. We'll talk to you very soon. Keep stacking. Bye for now. Peace.